Hello my dear students, this is the third record for chapter 9, and we were going to solve two problems in your book. Problem number 1, 920. The Zeep Watch Company manufactures trendy, high quality, moderately priced watches. As the Watch Senior Financial Analysts, you are asked to recommend a method of inventory costing to the CFO. Will use your recommendation to prepare the Z watches in 2014 income statement. The following data are for the year ended December 31, 2014. And he gives me some data in the income statement. This data that I shaded it here in a rectangle is income statement. Beginning some data from the income statement. Beginning inventory in Jan 1, 2014. Ending inventory December 31, 2014. And the beginning inventory is 85,000 units, and ending inventory is 34,500 units, and units sold are 345,000 units and 400 units. Selling price is $22 per unit. Variable manufacturing cost per unit, including direct material, is $510 and variable operating and marketing cost per unit sold is $1.10 per unit sold. And fixed manufacturing cost is $1,440,000. Monitor level machine hour is 6,000 hour. Standard production rate is 50 units per machine hour, and fixed operating and marketing costs is $1,080,000. Assume standard cost per unit are the same for the units in beginning inventory and units produced during the year. Also assume no price spending or efficiency variances, and any production volume variance is written off to cost of goods sold in this method in the month in which it occurs. المطلوب or required: prepare the income statement under the variable and observation method. And number 2, the Z Watch operating income at percentage of revenue, يعني the percentage of operating income to the revenue. Number 3, explain the difference in operating income between the two methods. And number 4, which costing method would you recommend to the CFO and why? Let's go to required number 1, and we will prepare a income statement under the variable method first time, and second time is prepare a income statement under observation method. First, here he gave me the beginning inventory units. It was 85,000 units, and he gave me the ending inventory unit. It was 34,000 units and 500 units. And he gives me the units sold. It was 345,000 and 400 units. And he didn't give me the units produced or units manufactured. So we will write an equation. This equation said that, and this equation is you can take it by the cost of goods sold equation that we take in chapter 2. And we said before that beginning inventory plus the production units or units produced during the year must equal the units sold and ending inventory. So our input must equal our output. We have a beginning inventory and the production. This is the our total inventory during the year. So this total inventory must equal the units sold and the ending inventory that remain in the inventory. So we will write this equation like this here: beginning inventory plus production our units sold during 2014 must equal the units sold during the year and the ending inventory, like this, as I write it here, and I'll color it by the yellow in order to see it. So we will use number now. Beginning inventory equal 85,000 units plus the production. I didn't know it. Must equal the units sold. I know it from the given numbers above. It will equal 345,000 units and 400 units plus the ending inventory equal 34,000 units and 500 units. So after we use the number, we will find that the production unit will equal 294,900 units. So here we get the units produced and we get the units sold, and we have the beginning inventory and we have the ending inventory, so we can prepare the income statement easily. Income statement under the variable costing method will equal revenues minus variable costs or variable cost of goods sold or plus variable operating costing will equal the total variable cost, and we will get the contribution margin. After that we will subtract the fixed costs or the fixed manufacturing and fixed operating costs, and we will get the operating income. So we have the main division, the main items in the income statement is revenues as we said before in our first record or for chapter 9, minus all variable costs. And we said before that variable costs consists of variable cost of goods sold, as we said, as we see here, and variable operating costs. So our first step is to compute the revenues. Revenues equal units sold multiplied by selling price. Units sold here is 345 1,400 units multiplied by selling price, and he gives me it give it to me $22. So the sales revenue will equal 7 million and 598,000 and $800 minus variable costs. And variable costs we will get variable cost of goods sold plus variable operating costs. Variable cost of goods sold, how we can compute it? As we said, variable cost of goods sold or cost of goods sold will consist of beginning inventory plus variable manufacturing cost will give me a cost of goods available for sale, minus ending inventory will give me cost of goods sold. Here beginning inventory units will be beginning inventory units was 85,000 units. We will multiply it by 5 by variable cost per unit. It was variable cost per unit was $5.10 variable cost per unit. So we will multiply the beginning inventory units by the variable cost per unit, because we compute the variable costs or the variable cost of goods sold. Beginning inventory plus variable manufacturing cost, variable manufacturing cost of units produced of production during the year. So we will here we will multiply the variable cost per unit multiplied by units produced, not units sold, or not beginning inventory unit or ending inventory unit. We will multiply by the units produced, which equal 294 and 900 units. So we will get, after that we will get cost of goods available for sale will equal 1,937 and for $490. And after that we have to deduct ending inventory. Ending inventory will equal variable cost per unit multiplied by ending inventory units. Ending inventory units was 345 and 400 units. So we can get the total variable costs was 2,141,480 we will this is the total variable cost that I will color it here by the red. Okay, by the red. We will subtract the total revenues 7,000,000 and 598,800 dollar. Subtract sales revenue minus total variable cost will equal the contribution margin. Contribution margin, I'll color it by the yellow. Okay, after that we have to deduct all fixed costs, fixed manufacturing and fixed operating, all fixed costs, because we use the variable costing method. We will deduct the fixed costs from the contribution margin. As we said before, these fixed costs are expenses or treated as operating costs or period costs. After we deduct fixed manufacturing and fixed operating costs, and he gives it to me direct in our given number above. So we will get the total fixed cost $2,520,000 and I'll color it by the red here. So we deduct the contribution margin, fixed cost from the contribution margin, and obtain the operating income. And this is the operating income under the variable method. It will be here, and I'll color it by the yellow in order to see it, or we can color it by another color, by the green in order to see it or differentiate it. Okay, second method is to prepare the income statement under the observation method. Under observation method, we need to know something. We need to concentrate on the variance of the production level. You have to see what is the variance of the production level here, in our example. So first you have to note that maybe there is a variance, and this variance will affect on the fixed cost or fixed manufacturing cost. So we can say that we have fixed manufacturing overhead. Fixed manufacturing overhead costs was $1,440,000. This this fixed cost is $1,440,000 was we suffered it. We paid it for how many units in production for the 294,900 units, اللي هي units produced. okay. اللي هي units produced that we calculate it at the beginning of the example, our solution, at the beginning of our solution. So, and we said before that we have 6,000 denominator level machine hour. Level machine hour, we spend 6,000 machine hour in order to produce these units. So we will divide the fixed cost on the level of a machine hour in order to know how many dollar we suffer or we claim per machine hour. So we will divide the total fixed cost or total fixed manufacturing overhead costs on the machine or level of a machine hours. We spend 6,000 machine hour and we claimed $1,044,000 on fixed costs. So every machine hour I claim $240. So every machine hour we will claim fixed cost per unit $240. طيب we need to calculate per unit fixed cost per unit fixed. So we will calculate, the next step is to calculate fixed manufacturing overhead rate per unit. We said per hour we will claim to $240. And he said in our given, in the above, in the head of the example, he said that standard production rate 50 units per machine hour. That 1 hour gives me 50 units. 1 hour gives me 50 units, and 1 unit gives me or claims me 240. So we will divide 240 divided by 50. So each unit will have $4.80, and this is the fixed manufacturing overhead allocation rate per unit. So after that we can prepare. So we here you will understand why I did this calculation in order to obtain the fixed manufacturing overhead rate per unit. بالعربي عايز اعرف كل وحده من الانتاج اللي هم البرودكشن يونتس كلفتني قد ايه، كل واحده كلفتني قد ايه. في الاول حسبت، اول حاجه حسبت التوتال فيكسد كوست على ال 6000 hours، على عدد الساعات اللي انا استخدمتها في الانتاج او اشتغلت فيها. فطلع لي ان كل وحده بتاخد $240 بير ماشين اور للساعه الواحده. طيب الساعه الواحده كل واحده بتاخد $240 بير ماشين اور. طب الساعه الواحده اساسا المفروض ان انا شغال 50 يونت للساعه الواحده، 50 يونت للساعه اساسا. المفروض هو مديني في المعطيات او في البرودكت في الجيفن نمبرز في راس السؤال 50 يونتس بير ماشين اور. طب انا عايز اعرف دلوقتي ال $240 دول هحملهم على الوحدات ازاي؟ يبقى 240 على $50 على 50 يونتس عشان اعرف كل وحده بير يونت هتاخد قد ايه. يبقى هلاقي هقسم ال 240 على ال 50 هديك $4.80 per unit. And this is considered the fixed cost per unit to the production unit. Again, we did this for the production units. Let's complete it. Income statement under observation method. will calculate compute it also with the income statement with our usual figure. Revenues minus here بقى, because we are under observation method, we will deduct total cost, total. So we will total cost of goods sold, total كلها fixed and variable. So revenues is computed by multiplying selling price multiplied by the units sold or the quantity of units sold. So it will be 7 million, the same sales revenue. And the cost of goods sold is computed by beginning inventory plus variable manufacturing and fixed manufacturing. And here there is an important unit. Here in the above income statement, we when we calculate the beginning inventory cost, we used the variable cost per unit and multiplied it by the beginning inventory units. Here we will have the two, fixed cost per unit and the variable cost per unit. So the cost per unit will be consists of two items or two numbers. One part is the variable, which is $5.10, and the other part plus the fixed part that we computed it above $4.80, and we will we will add these two numbers together and to obtain the variable cost per unit and multiply it by the number of units of beginning inventory in order to obtain the cost of beginning inventory minus variable manufacturing cost. And in this we will calculate the variable manufacturing cost for the units produced. So we will variable cost per unit multiplied by units produced here in the variable manufacturing, and add اللي هي الفixed or allocated fixed manufacturing cost, الفixed cost per unit multiplied by units produced in order to obtain cost of goods available for sale. And we will deduct the ending inventory also. The ending inventory also will have both fixed and variable. So we will have add the variable part first and then the fixed part in order to calculate the fixed cost, in order to calculate the cost per unit, the variable part and fixed part, and we will multiply them to the units of ending inventory in order to obtain the ending inventory cost. And this is deducted, so we will put it between brackets because it's deducted. Here there is an important point that I talked about it in our first when we define this method, اللي هي absorption method, and said that we have to know the variance in the production. He said in our example that we claimed how many fixed cost by he claimed fixed cost by cam that we have total fixed cost, total fixed manufacturing cost, it was $1,044,000. Okay, and he said that this costs and we have 6,000 hours, and we have 6,000 hours in the level of production. 6,000 hour we will work 6,000 hour, and in each hour we will produce 50 units per machine hour. So if we multiply 6,000 units, 6,000 hours by 50, we will get 300,000 units. So here this cost was to the 3,000 unit, but he produced here 294 and 900 units. So there is a variance in the production. There is a variance. He claimed the $1,044,000 for The 3000, I make it as a note here, and I'll color it by the yellow in order to see it. Here I calculate the variance in the production. First, we calculated the production that he gives us that we must produce. It was 6,000 hour multiplied by 50 unit. So we will produce 3,000 units. But he produced as we said, as or we compute in the beginning of our solution, he produced nine. I produced 294 and 900 units. There is a variance in the production, and this variance will result in how many units variance. Here is a difference between these two numbers is 5,100 units. These 5,100 units are variance in the production. So this variance must be added to the ending, and we will calculate the cost of goods sold. ماشي. We will add the adjustment for manufacturing variance. This adjustment will be added, and we will calculate and we write the letter U, unfavorable variance, and we will calculate the cost of goods sold after we adding the unfavorable variance. So we can we can compute the gross margin or the contribution margin by subtracting revenue, the cost of goods sold. I colored it by the red. The cost of goods sold minus the sales revenue. I colored it by the red in order to see it. ماشي. And this is the cost of goods sold. And we subtract them together from each other, and we compute the contribution margin. After that, we will deduct the operating costs or variable operating costs, and fixed are expensed or period costs. So the operating costs will be 1,459 and 94,000, and we can calculate the operating income. It was 2,694 and 920, and I'll color it by the green color. Here we compute the net income under the observation method by 2,694 and $920, and under the variable costing method 2,937 $320 under the variable and under the observation. Here, what is the operating income or percentage operating income of revenues? Here we can divide the two numbers each together and multiply it by the 100% in order to get the percent. It will be under the variable 38 and 7%, and under the observation it will be 35.5%. And you can see that operating income using variable method, using variable costing, is about 900 higher than 9% higher than the operating income calculated using the observation costing method. In order to make sure that we cover this very good or clearly, we can explain the difference in operating income between the two methods. The income under the variable was 2,937 and 32 and 320. This is the operating income under variable minus the operating income under observation method that was 2,694 and 920. This is the operating. We can subtract each other. It will give me the difference is 242 and 400. This is the difference. And if we subtract the fixed manufacturing cost in beginning inventory under the observation fixed manufacturing, it was fixed manufacturing in the beginning inventory minus the fixed manufacturing in the ending inventory under observation, also under observation fixed manufacturing in beginning and fixed manufacturing in ending. It will be as I calculated here, the difference this minus this, the beginning, the fixed manufacturing in the beginning and the fixed manufacturing in the ending, the same number or the same difference in the operating income. So we can say that the operating income or the difference in the operating income is we can say that the operating income, the difference in the income because of the difference because of the fixed manufacturing costs, and this is the same difference. Okay, I hope you understand it clearly. Here I get another example in order to solve it, and it is the same idea. I hope you can solve it by yourself on your home. If you find any problem, just comment. I'll see your comments, and I'll record it inshallah if I found that some of you didn't solve it. I can help you and record it also to you. I hope you try to solve it by yourself, and I record it inshallah in the next section. I hope you solve it. I'll show it quickly. Here we have some data for the Regina company, and Regina budgeted to produce 20,000 units, and here he gave me the some units in the that I will need in the preparing for income statement. Units produced 18,000 units produced. He was budgeted to produce 20,000 units, but units produced actually 18. So the variance in the production was 2,000 units. Units sold was 17 and a half. Selling price for 450. Variable manufacturing cost. Variable manufacturing cost per units produced, direct material, direct labor, manufacturing overhead, marketing cost per units sold, variable marketing, and fixed costs divided to manufacturing cost and administrative cost and marketing cost. Okay, he needs to prepare the income statement under the two methods and to explain the difference in the income on the operating income between the two methods. Here we can say that income statement under a variable costing method, we need to calculate the variable cost, the variable manufacturing cost. Variable manufacturing cost or variable cost per unit here will be 30 plus 20 25 plus 60. So اللي هي كانت ايه عبارة عن ايه اللي هي variable manufacturing cost per unit اللي هي it was direct material equal $30 and direct labor $25 and manufacturing and manufacturing overhead 60. This is the variable cost per unit. Variable cost per unit will equal 115. So we can calculate the operating income by this way. أو first thing is to prepare income revenues units sold multiplied by selling price. This is very easy and direct. Variable costs, beginning inventory. We didn't have a beginning inventory, so the beginning inventory was 0. Beginning inventory plus variable, because we under the variable method we use the variable manufacturing costs only. variable cost بتساوي variable manufacturing cost بتساوي الunits produced في variable cost per unit. units produced, not units sold. units produced when we calculate the variable manufacturing costs or the cost of the beginning inventory or the cost of the ending inventory or the cost of the variable production during the year, we use the units produced. When we calculate the cost of beginning inventory, we use the units of beginning inventory, not the units sold, not the units produced. When we calculate the cost of goods, the cost of manufacturing cost of units produced during the year, we used the units produced during the year, not the units of ending inventory, not the units of beginning inventory, not the units sold. We have to differentiate between the units. We have units produced, units sold, and units of ending inventory and units of beginning inventory. Each unit is used in each place. Don't mix between them. Here we need to calculate variable manufacturing cost during the year, so we will use the units produced. We will get cost of goods available for sale minus ending inventory, so we need to use the units in ending inventory. Ending inventory was 500 units multiplied by variable cost per unit, because we use we prepare the income statement under the variable method. بلس يبقى كده احنا جبنا الفاريبل كوست اوف جودز سولد بلس variable marketing cost. الفاريبل marketing cost الunits sold because we market for the selling units. units sold في variable marketing cost per unit. total variable cost, and we will deduct total variable cost from the sales revenue. We will get contribution margin. After that we have to deduct the fixed manufacturing directly without any effort. It's very easy and simple. Deduct the fixed manufacturing and fixed administrative and fixed marketing, and we will get the operating income. There is nothing here difficult. After that we have to prepare the income statement under observation method. As we said before, I have to here differentiate between the units produced and the budgeted. It was budgeted to produce 20,000 units, and the actual or the production during the year were 18,000 units. So we used the fixed manufacturing overhead cost that was 1,200,000 in order to produce or that we budgeted that we will produce 20,000 units. So the rate will be $60 per unit. So the fixed cost per unit is $60 per unit. So we will solve the income statement. We will prepare the income statement under the revenue. Clearly simple. units sold في selling price. cost of goods sold total, because we use the observation. Total cost of goods sold equal beginning inventory 0 plus variable manufacturing cost. variable يبقى احنا هنقول variable cost per unit multiplied by units of of production او units produced اللي هي 18,000 plus fixed manufacturing cost. fixed للproduced، يبقى units produced في fixed cost per unit. يدينا cost of goods available for sale. deduct ending inventory. ending inventory will have both fixed and variable, so or the variable cost per unit. The total cost per unit variable and fixed. 500 multiplied by variable part is 115 and the fixed part is 60. ماشي. After that we add the unfavorable variance. Do you remember it? How we can calculate it? Here we budgeted to produce 20,000 units and the actual production was 18,000 units. So we have a variance in 2,000 units. How we can calculate the we can say that 2000 multiplied by 60, it will be the variance will be 120,000 units, $120,000. This will be the unfavorable variance. Or we can say that we can deduct 1,200,000 units minus 1,080,000 اللي هو allocated above. The difference is the same number is $120,000 units. You can get it by two ways. I hope you understand. So we add the unfavorable variance. After that we will get the cost of goods sold and deduct the cost of goods sold from the revenues to obtain the contribution margin. After that we have to deduct the operating costs, which are variable marketing, fixed marketing, and fixed administrative, and we will get the operating income under this method. And like what we did before, operating income under observation and operating income under variable, the difference between them here is 30,000. The difference between the two numbers is $30,000, and the difference between the fixed manufacturing cost in beginning inventory and the ending inventory was $30,000 also. So you can solve it again and study hard in order to understand the variance in the production level, what is the effect of it on the fixed cost. I hope you clearly understand. Thank you very much.